Last week, we started the series Endowments Unfiltered, where we were giving you a lot of information on how endowments works, how the structure. We spoke about the advantages, the disadvantages. If you've not watched, please go to the link on the description box below so you can watch that video before this one. So today, we're going to continue on this series. This is part 2 of the series where we're going to talk about, right now you have that endowment policy. Maybe it's not working out for you. What next? What can you do now moving forward to make sure that whatever it is that you have is helping you reach your goals? So we're going to talk about, at this point, what are the steps that one can take or you can take to be able to move forward in a way that you do not lose all your money or you get very minimal interruptions. In addition, we're going to show you how you can build your own structure. Remember, when it comes to endowment policies, it's 2 products which are put in one, right? The savings and the protection. But what if you want to create your own structure? What if you want to separate them so that you can maximize on growth and also maximize on the protection while minimizing the costs? So during this session, we're also going to go through that so that now we can give you guidance on how you can create your own portfolio from scratch. So now, what do you do that you have found that the policy is not for you? Say you got an education policy or you got an endowment policy, but then when you go to the terms and conditions or when you're working out your numbers, it's not working out. It's just not making sense. It's not helping you reach your goal. Because again, before I even go into the next steps on what exactly you can do, you have to be very clear on why you got it, right? Why did I buy this policy in the first place? Because again, it's important to look at the end goal before you even make any decisions now moving forward. You need to know that now the end goal and whatever it is that I see this policy achieving, it's not matching. Say, for example, you bought this policy at that time because you didn't have knowledge and what you were looking for was actually growth. So when you look at the numbers, it's not necessarily helping you grow and you are looking for an alternative. Or maybe when you got this policy, what you were looking for was protection. And remember, when it comes to protection, based on even the other videos that we've spoken about, protection and life insurance and the level of coverage, you know you need ideally at least 10 times of your annual income, right? 5 to 10 times of your annual income. But now with the policy it is that you're paying for with the endowment policy, it's not helping you achieve the level of protection that you want for your children or whoever it is that you're choosing to protect. So you need to see, this is what it is that I have, and this is my goal, and there is a gap. It is just not matching. So that is when now you go to the next step. Number 1, if you've had your life policy or endowment policy and it's not been 30 days yet, you can actually cancel it and get your money back. Again, it's always important to go back to your policy document. This is what we call a window period. So during the window period, the insurer is giving you time to go through your policy document and to see that this is what I choose to buy. It's what what the agent told me, and it is in line with what it is that I want to do and where it is that I want to go. Because a lot of you are in so much trouble because this is the stage that you skip. You don't even ask for your policy documents. I'm sure some of you don't even know where your policy documents are at. This is the time to go and pull it out to just make sure you know what it is that is written in there. So if within those 30 days, you have gone through the policy document and it is not helping you achieve what it is that you wanted to achieve, you can cancel it. You put it in writing, send it to your insurer, the customer service, and say that the math is not mathing. Okay, you don't have to say the math is not mathing. Just say, I've gone through my policy document and this is not what it is that I want. So you can go through your agent, whoever it is that who helped you. Most probably, if you were trying to cancel the policy, it might not be something that they will be happy to help because, again, nobody wants for you to cancel this policy. So if they can't help you, you can go directly to the underwriter, but it should be within the first 30 days. Okay. And secondly, what happens if it's been over 30 days? Say it's between day 31 to up to 3 years. Because remember, if you have a life policy or an endowment policy, especially now an endowment policy, because it's the one that has cash value or surrender value, within the first 3 years, you are not able to pull out your savings. Okay, so if you've been putting money aside for maybe 2 months or 3 months, and you're like, hey, this one, it's not making sense for me. So what you could do, because you've not put in such a maybe quite a lot of money, you could choose to forego everything that you've already put in, right? And so that you don't end up losing more, because again, usually there's what we call the sunken cost fallacy, right? You have seen that this thing, you're putting in your money, you're putting in your investment, but you are not getting the return it is that you want. But because you've already put in quite a significant investment, it's hard for you to pull out. But again, it's important to look on the side, the opportunity cost. If it was protection and the level of protection of this policy is not making sense, it might make sense for you to now stop with this one and get another one, right? But again, I always advise, if you're to stop a policy completely, you can use an advisor, so that, again, remember, you're already on with some level of cover, and we don't want something to have happened in between and there's absolutely no protection. So be careful even before you cancel. Or another option could be, maybe you have gone in it for quite some time. You could choose to reduce the premium that you're contributing. Some underwriters allow for this. So yes, you've started with X amount, say you started with 30,000 or 40,000, and then you're like, okay, this is not making sense for me, but I don't want to lose the amount of money I've put in completely. So what you could do is reduce the premium that you're contributing. And again, this has to be put in writing. You have to write it, to send this in writing to your underwriter or your life insurance company, so that now they can reduce the cover or reduce the premiums it is that you're contributing, because they need to adjust the level of protection, and they're going to share with you a new policy schedule. Okay, so number one, you could either completely cancel it depending on what point it is that you have this cover, or you could completely reduce the premium, even maybe to a minimum, so that you do not lose all the money. And again, please use an advisor for that. We also help with policy reviews. And in case you need any guidance, especially when it comes to that, you can hit us up. Or another thing it is that we're planning to do is to share a video on how you can do it yourself, right? Because again, that will be very helpful if you are able to see, okay, I was looking at this from a stance perspective. I was looking at this from, protection perspective. And when I say review, that means numerical review, and also looking and reviewing the terms and conditions. Because again, it's not also only about the numbers. It's good to know, when it comes to the terms and conditions of this policy, is it serving me? Because we have seen quite a number of policies out there which don't even cover death due to giving birth. Again, this is some things that women have no control over. And not all policies exclude that, but it's an exclusion to some policies. So it's important to know what it is that you have and if it is serving you. If you're a woman and you have this type of policy, it will be unfortunate if you are giving birth and you're to pass away and your people don't get paid, or at most maybe it gets a return of premiums, right? So that is if it's between day 31 to year 3. That means that at this point, you cannot pull out your savings, but you still need an alternative, right? So let's go. Now it's been year 3 plus, right? So what it means is that your policy has accumulated a surrender value or cash value, because an endowment policy, as we'd mentioned, has a savings element. So you see the protection element that we're not touching, but you're saying that with regards to the savings element, there's an amount of money that you've accumulated. So for some underwriters, it's 3 years, and I've even seen some underwriters, it's 5 years before you can access your surrender value. So again, I encourage you to go to your policy document and read it and understand, so you don't get surprises in the future and say, oh, all insurance agents are con men, right? So it's also your responsibility to know what you're buying. Okay, so now it's been over 3 years. You're going through this policy and you feel that this is not it, right? Maybe you're looking also from a level of growth. And at that time when you're buying it, it looked really good at that point, but you didn't necessarily have full knowledge, and now you're looking at it, it's not serving you, it's not growing as fast as you wanted, or it's not giving you the level of protection you wanted. So what you could do at this time, so I'm going to give you the different options, but as I said, please use an advisor. Don't just cancel it just as it is, because you can also get into trouble. So firstly, there's the surrender option, which you can end up losing quite a bit of money, because remember, as I'd mentioned, one of the disadvantages is the fact that the amount you get as a surrender value is pretty low compared to the premiums you've put in. Because remember, based on the structure, part of it goes towards protection, part of it goes towards fees, and a part of it goes towards your savings. So maybe by that time, the amount of money that has gone towards the savings has not grown to the level of it matching the premiums that you have contributed. And again, remember, you also had this contract with the insurer. You told them that you're going to be paying this premium for the next 15 years, and now you've changed your mind. And remember, you cannot just decide to change your mind with regards to a contract. That's why you need to make sure that you're getting it right from the very beginning. Because if you changed, there's going to be repercussions for trying to change your mind in between. Because there's a way that they've projected this policy, and now you're disrupting whatever it is that they've projected. So say now you're in this situation. So surrendering is an option, usually one of the most painful options, because you're going to get less money. Again, different policies are different. There's some which after a certain period of time, maybe you might be able to get whatever it is that you have contributed. But it's important, as I said, again, go to your policy document and find out. And number two, there's what we call paid up option. Right? So say, yes, you've contributed of this over 3 years, and you do not want to withdraw this money because it's going to be too painful, right? So if you do not want to withdraw this money, what else can you do? What you could do is now convert it to what you call paid up option. What is paid up option? This means that you stop, yes, contributing towards the premiums, but then based on the amount of premiums that you've already put in, they're going to give you a new sum assured. Because remember, the sum assured you had at the beginning was based on you completing all the contributions. But right now, you stopped contributing, say, in year 5, right? So the amount of premiums are going to give you a new sum assured. So you can choose to stop contributing, and then they give you your new sum assured, which is going to be paid up upon death or maturity. So it's like your money is just chilling there, more or less. But again, whatever amount of money maybe you were contributing towards the insurance company before, you can now put it towards an alternative, right? So if your goal was growth, you can put it towards an investment. And if your goal was protection, you can put it now towards a pure life cover so that it can give you holistic protection, right? Number 3, if, say, you still want to continue with this policy, you can also reduce the premium that you're contributing. Just like now, as I'd mentioned, if it was after 31 days to 3 years, you can still do the same here. You can be like, okay, I'm here, but I do not want to continue contributing X amount. So I would rather, say, as I mentioned, you're contributing 30,000. So you could even reduce the contribution to, say, 10,000, and the 20,000 you put somewhere else. So that now the growth, if it was for growth, the growth can be faster, or if it was for the protection to be bigger. Again, the restructuring is now going to be in your own hands. It's up to you to sit down with your end goal and to see, why exactly do I want this? What is my reason for this policy? What was the reason for me creating this structure? And again, you can do it by yourself, or if you're not comfortable, you can reach out to us and we can be able to help you restructure your policy, right? So that is the option. And now, if you're, say, closer to now the maturity, say it was a 15-year policy and it's year 13, eza kujikaza. Yeah, you can try, because you've gone almost over 80%. So just finish it up, because again, sometimes you get people who want to liquidate or to pull out, say, in year 13 or 14. So what you could do is you can continue, or if you completely, like, it's you're not feeling it at all, reduce the premium, or if the surrender value makes you happy, you can be able to withdraw it. But all these other options that I'd mentioned earlier can still be done even when it's in the later stages, but most of our clients choose to finish up with it, right? But if the resources are limited and you still want maybe to get an extra level of protection, or you would rather put that money towards an investment, then it will be good for you to maybe reduce the premium and then reallocate. So most probably the sum assured might change, but not drastically, because you have contributed for a very long period of time. So it's good to just have all your numbers, right? Have all your numbers. Look at your statement, because again, all insurers should be giving you statements. I have a prospect. We had a client who told us their insurer was not sending them statements. When she's trying to call the insurer, they don't pick up calls. That was a very big red flag. Yeah. So always, please, if you get an insurance policy, try and pick up the call and call them to see if they're gonna pick up. Yeah. Anyway, in that now, when it comes to now that situation, it will be very important now to, again, make sure that everything is in order. With everything said, you have to be extremely careful with cancelling a life policy. Because remember, with life policy, especially when it's been running for a period of time, if it's within the first 30 days, it's not such a big deal. But say this policy has been running over a period of time, let's say it's been about a year, right? If you're taking this policy for the sake of protection, and for example, you're like, hey, I don't like this policy, and then you just cancel it as it is, you will leave your family exposed. Because remember, you can cancel this, and if you already don't have another policy, that means that where is the family going to get protection from? It doesn't matter whatever it is that you've been contributing up to that point, because the moment you stop paying, you are no longer on cover, right? So it is important to now put some of these things into consideration. So maybe what it is that you could do so that you do not lose everything. Like, let me give you an example of one of our clients who took up a policy and it was just not making sense for him, right? Because he was covering his wife and his children. So he was paying about 30,000 per month towards this endowment policy. And he told me the main reason he was taking that policy was because he wanted protection. And when he asked the advisor or the insurance agent at that time, the insurance agent told him that the only thing that's available is an endowment policy. So he didn't have the knowledge that he had until he encountered us, right? So he came to us, and because we understood that, yes, you need that protection and you need to change because it makes more sense, we told him that he can be able to run two policies at the same time, right? So this one he had to reduce it to a certain extent so that his family is not completely exposed, and then he starts now this other policy for at least now the next 6 months, so that the waiting period is over, especially due to due to an illness or critical illness cover. There's usually a waiting period for 6 months. Again, depending on the underwriter, depending on the insurer, very important for you to be clear on what exactly is written in your policy document, so that now eventually he still maintained this one a small cover, and then this other one was doing what it is that he wanted to do. There's some others, after that period of time is over, they just cancel, right? Because the waiting period is over, they're fully covered with this other cover because their main goal was protection, and then they move forward with their lives. Again, this is why I say to cancel it sometimes by yourself might be dangerous. So if you need guidance, please reach out to us. We'll leave the link down below and we'll be able to guide you. But again, as I said, with the information it is that we're giving you here, and we're going to share a video where we do the analysis. So maybe if you want to do it yourself, you'll be able to do it yourself so that you can make the best decision. This week we've spoken about how you can move forward if your policy is not making sense for you. And again, please, 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 please always start with the end in mind. And there's no one size fits all. Canceling does not have to be the answer for everybody. Converting it to a paid up or surrendering it is not a plan for everybody. Everything depends on what your end goal is. And as I said, with a little guidance, you'll be able to know what is the best plan for you, right? And now we have the people who are moving forward or currently want some alternative to maybe education policies or endowment policies, because again, to each their own. There's the people who endowment policies work for, and that is all good. And there's the people who are like, this is not something that is for me. I don't want something that is constricting me. I don't want something that's not as flexible. I want something that I have some level of control in my savings, I have control in my investments, and I also want some control in my protection so that I can, minimize the cost and maximize the benefits. So next week, we're going to talk about the alternative way of planning your protection and investment. Because yes, we're shifting from endowment policies, but what are we shifting to really, right? What else is out there? Because for the longest time, we've always thought that there's one way of going about this planning. Because at the end of the day, growth is very important and protection is equally as important. Growth to make that money, protection to keep that money. Because a lot of us, especially a lot of you who are watching me right now, are in what we call your wealth accumulation stage. So we need to make sure that even as you're accumulating this wealth, there is a way that you can also equally protect it, so that we make sure that in the case of the unforeseen, there is a place that you're going to land. And again, it just makes a holistic portfolio. So don't forget to like, subscribe, and click on that notification button so that you do not miss next week's video, because again, that's when we're going to go in deeper on how you can structure your own plan. See you next week.